Hello, everybody. This is Crypto Rookies once again, and accompanied by Jane again. How's it going, Jane?
Hi, Patrick. All good, all good. I'm really excited for our next topic, which will be covered not only in one session. So I'm really excited to go step by step and look for any questions or something interesting insight that we can tackle there.
Yeah, I think tokenomics is probably my favorite topic. And yeah, before we get started on the topic, the reason why tokenomics is so important is because there's long-lasting effect on the economy of a project and the price movements. So this is like, I keep discussing about my strategy where I make about 10% per month and it's market neutral with grid bots. So before we get to explain how that strategy works, we need to basically put a crypto project in different categories, losers and winners. So this way we short the losers and we long the winners. And in order to do that, tokenomics is one big criteria that I use to position which project goes into which bucket. So it's one of my favorite things, but yeah, it's a really complex topic on its own. So it will take several sessions to cover that. So yeah, before we go too far, I'll just mention one thing is that the way I personally define tokenomics is basically just the process of engineering value into digital assets. It's like a programmable money, if you will. But the same thing applies to fiat currency, US currency, or any other currency. The monetary policy behind it is equivalent to tokenomics. It's just tokenomics is for tokens themselves, but the same principle apply to almost everything. And at the end of the day, it's really about the laws of supply and demand. So if you look into macro and macroeconomics theories, I think price is really dependent on your demand for a product or a commodity or anything, and then the supply of it. And then if you move and you increase the supply, chances are if the demand doesn't increase, that the price is going down. Meanwhile, if you reduce the supply, the blue line or the blue curve move to the left, and that push the price to go up along the demand curve if the demand curve is fixed. But the same thing is true if the demand curve move and increase or it decrease. It also assuming that the supply is fixed, that it move the price. And I think this is not always precisely happening on the spot, but the market try to remove inefficiency over time. So yeah, that's pretty much it. So before we go into further detail, feel free to ask me any question because there's an entire class in university about macroeconomics. So it's a pretty big topic on its own.
Yeah, but you would say like a blockchain, it works in a kind of similar way, or there are some exceptions that are not applicable as what we have on the macroeconomics?
It's not that it's not applicable. It is fully applicable, but with a token, you can encode mathematically how it behaves. So you can do things that world government with their monetary policy don't do. So you can engineer new ways to manipulate the supply and the demand curve, basically.
So you would say that on the economics terms that you can control and manipulate the data.
Yes, the behavior of the behavior of basically those curves. For example, here on the right, this is a kind of a demand and supply curve of Bitcoin. This is not entirely true because the supply of Bitcoin it is fixed. But as I explained last week, presently miners are mining new Bitcoin that are currently not in the supply. So even though the fully diluted supply is 21 million, right now there's not 1 million in circulation. So every year, every day, there's a tiny bit more Bitcoin being created, and eventually it will never go past 21 million. So here they represent the supply as a completely vertical fixed line, but that's not exactly true in reality. But at least it's better than US currency or any world government currency because they have unlimited supply. Government keep printing all the time.
Exactly.
Programmatically speaking, Bitcoin will never pass 21 million, and that's node upfront. So in which case, then the only thing that will basically change the price to a certain extent is really affecting the demand curve at that point.
But you would say, but Ethereum is a bit in a different way of focuses more on managing on demand.
Yeah, exactly. So Bitcoin, they took the choice of managing supply and they kind of engineered value through the aspect of scarcity. Like scarcity, if there's no demand, even if you reduce the supply of an asset, if nobody wants it, you're not increasing price. So people sometimes mislead themselves that scarcity can increase price. That's not always true. For example, you can reduce supply of, I don't know, NFTs or pictures of monkeys, but if there's no demand for them, it's not going to increase the price. You need demand in order to scarcity to have its effect, its true effect. And I think Ethereum, they chose not to have a fixed supply. Instead, a lot of their engineered value is through the manipulation of the demand curve. Because basically Ethereum is a decentralized operating system. What they're trying to do is having thousands and thousands of projects that build new products on top of Ethereum. And those products basically bring further demand. In their case, they're trying to really increase the demand over time, much more than trying to have a fixed supply. And more recently, I can explain that, but yeah, let's explain this before. I mentioned that also last week, but I think Bitcoin, the supply, as you can see here, is increasing. And every 4 years, the release of new Bitcoin is halved. So eventually it will kind of saturate to 21 million. But in the meantime, the amount of percentage of new Bitcoin compared to what's already in circulation is almost equivalent to gold production. The big difference here is that every 4 years, the release of new Bitcoin will decrease by half. So in the next 4 years, and that's the Bitcoin halving moment is happening in 2024, around, I think, between April or June, something like that. So at that point, the creation of new Bitcoin will actually be significantly lower than gold production. Every 4 years, it will decrease. Meanwhile, gold production could keep increasing over time, as you can see on this graph. And the thing in terms of percentage, it's been pretty constant amount of new production because there's gold everywhere. And eventually, if we manage to mine every gold mine that exists on the planet, eventually we can basically collect it from space, from asteroids, from other planets and stuff. So eventually, there will always potentially be new gold production to tap into. So that's why in the long run, Bitcoin will have more scarcity than gold, that's for sure. And last week I mentioned that coin is a risk asset and usually behave more correlated to the stock market. But in the past few weeks, it has been actually much more correlated to gold, which is pretty interesting. It's finally moving into that category, but I think the ETF will push it further into a refuge asset similar to gold. But
so you think that afterwards, the Bitcoin itself will be way more stable than before?
I'm not sure it will be more stable in the short term, but at least it will be more going up when the economy is at risk. Because gold, the thing, it's a refuge asset. Whenever there's talk about World War III or economic downturn and all of that stuff, if you're unsure what's going to happen to world government currency or about the stock market, commodity is typically a good place to, precious metal is a good place to park your capital, to preserve it, just to avoid the risk of a downturn. Because the demand will keep increasing over time. So the thing, Bitcoin is moving more toward that nowadays, but it's not fully correlated yet, but it's more and more correlated as of late. So that's really interesting.
Yeah, and is there kind of explanation of how Bitcoin controlled supply compared to traditional fiat currencies of monetary policy?
Yeah, it's if you look at US currency or any fiat currency, when there's economic downturn, typically speaking, they will print a lot more money in order to give it to the organization or to the people who are suffering to try to incentivize the economy to come back up. But all that printing is basically you're increasing supply of currency. And eventually, that's what happened is that all of that extra printing, unless it's taken out of the market, it goes back into risk asset over time. So that's why during COVID, when the US government started printing like crazy, the stock market grew pretty massively. Like some of the stock on Apple and so on, they doubled in price. But inflation was really high during that time. Even though the stock price of Apple doubled, the real purchasing power didn't double because of inflation. Your US currency value has significantly reduced during that time period. So that's the problem with printing so much, is that you reduce the value and the purchasing power at that level. So that's why Bitcoin, because it's a fixed supply and the amount of new Bitcoin being put in circulation every day is really precise. When there's an economic downturn, the percentage of new Bitcoin doesn't increase more than it was the day prior. So that's why it's very different. But all of it is playing with the laws of supply and demand again. So pretty interesting stuff.
Yeah, that's really how it might be correlated, and that's really interesting to see.
And the thing here, if you look at Ethereum, the supply, as you see, over the years, it was increasing quite a lot, but the demand was increasing faster. So this is why you saw the price of Ethereum still going up, even though there was supply on the market. And recently, one of the upgrades enabled the burning of Ethereum, so it became deflationary. There's never less Bitcoin on the market unless someone lose their key, their passphrase, then the Bitcoin is become lost. But overall, there's no destruction of Bitcoin. But Ethereum, the thing, for a period of time, the supply has actually decreased. So technically speaking, that's even better than Bitcoin to a certain extent. And I think in the past week or two, it has become again inflationary. So there's currently more Ethereum being created every day than destroyed. But I think this is actually manipulated based on demand and supply. So it basically adjusts to the market demand. So I think right now the demand is much lower for Ethereum. So this is why there's kind of manipulation and flexibility on what is being produced and what is taken out of the market.
Do you think in the future, like the Ethereum supply will go up?
There's a very large amount of new demand. It's very likely that there will be new creation, because the goal is not so much to have if the demand increased 10 times, you can afford to have more supply to not have the price skyrocket. Because when the price skyrocket, it become, at some point, people get too rich and they start selling. So you create pump and dump. So it's better that you try to absorb some of that volatility with moving the supply up and down a little bit along the way. I think it's favorable because then you can reduce volatility and the pump and dump. But I think the Ethereum, they are pretty flexible about upgrading their network to adapt to network condition and market and demand. So I cannot predict what exactly will be in the future, but so far it's an asset class that I really like. I prefer it over Bitcoin, but I can still see the real value of Bitcoin as well. And I own quite a bit of both, but I do have a tendency to prefer Ethereum. Just for the utility of it. It's not just a refuge asset, it powers new product to be created.
And how does Ethereum adapt to increase demand during the periods of network congestion?
Yeah, that's where the gas fee, it's basically the transaction cost when you make transaction, it spike a lot. And that reduce, every project that are built on top of Ethereum, it will cost a lot more to utilize. So that will reduce the demand. So that's how they're manipulating to a certain extent, the demand. So when there's congestion, the price of transaction go up so much that people start not using it anymore. There's future upgrade on the Ethereum network that are supposed to reduce the transaction costs massively. So we'll see when that come out. But meanwhile, you can use layer 2 of Ethereum. So this way, if you use a layer 2, for example, Polygon, you're making transaction and then they are bulk together. And then the bulk of transaction get written to the main Ethereum network once in a while. So this way you don't have thousands of transactions all the time. So that reduces congestion. So that's one way to still use the Ethereum network, but benefit from lower transaction fee and increasing the capacity of the network entirely.
So there is solutions to reduce the transaction cost.
Yes.
But people have to know what are the solutions that are correlated with the Ethereum.
Yeah, I think it's a learning curve. But the thing is that developers are the one who have to know about that stuff. Like the general public, if they decide that they want to use a specific application, it's the developers that usually manage that on the background. Sometimes you have the choice of which network to use, but you can just use the default settings are also. So you can hide some of the complexity from the general public.
Okay. I think it's quite really wise topic about Ethereum, and there are many things that has to be still on process to improve it.
Indeed. So one thing I wanted to mention, that's another project. It's called SUI. And the graph that you see here, it's basically that a lot of projects, they kind of emit new token to put them in circulation. And in this case, the release of the token, and that's a topic that we, a term that we call vesting, is that some people basically bought the token or they were allocated some token before the project launched publicly. And then vesting means that those tokens that were allocated to you become available to sell. So they become available for you to make transaction with. Otherwise, before they are vested, they belong to you, but you're not allowed to trade them. And as you see on this graph, the maximum amount, it's between multiple categories of allocation, but the supply is increasing a lot. And in this point of time, that's in the middle of 2024, there's basically a double the amount token that will hit circulation. So this is extremely risky for the project, for the price to dump, because there could be a massive amount of people who sell anticipating that when the token are vested, a lot of those people will want to sell. So some people will sell before that happens. So often, a lot of projects suffer massive price collapse when there's such a massive amount of token hitting the market all at once. So it's really important to look at token.unlock.app. You can look at a lot of different projects and see what the token unlock investing looks like. So I use that quite a lot to know in the long term, what is the risk that the people, the demand, will it offset the release of those token in circulation, because that's a lot of potential selling volume happening over time.
I actually heard about unlocked tokens, but specifically, what does it mean, for example, when tokens are unlocked linearly, like how it affects the whole process?
Yeah. So if you see my cursor from this point to this point, it's pretty linear in terms of how many tokens get released. Meanwhile, this is not linear here because that's a really sharp increase. When it's linear vesting, the advantage of that is that you don't have a massive amount of token hitting the market all at once. But on the other end, if you look at some projects like traders, they like support and resistance zone that are clear. So when they trade token, they like to see that there's Fibonacci retracement. They do all of the technical analysis to say, oh yeah, if the price go back there, I'll want to buy here. If it's a sharp amount of token hitting the market, and then the price have a sharp decline, the traders, if it follows certain kind of patterns, they are much more likely to buy because they see, oh, I'm going to buy at a discount, and I know that the price will go back up, so I'm benefiting from the discount. So that's the advantage if you have a sharp kind of release, because then it may actually push the token down, but in a way that the traders love to just buy back at that point. So you do suffer, but at the same time, it becomes more predictable. Traders suffer a lot predicting a linear vesting and linear token release, because then it doesn't, when does it actually have a retracement and when it does not? So it becomes harder to make prediction, and the traders find it a bit more difficult, especially when it's a slow bleed. It's hard to take advantage of that to make money. So there's pros and cons in both approach. But the thing, what you have to be careful is you're doubling the amount. That is a very risky thing to do. I wouldn't really not have done that. Meanwhile, if it's a slow bleed, personally, as long as the demand is growing organically month over month and it's better than the release, that's fine. You're not in trouble. But can you have that much demand? That's the other thing. Because a lot of projects, they don't really have real users, and that's something we can come back to. But most of the users are speculators that just want to make money driving the price growth. So if you don't have real users that want to use your technology and you have a slow drip like that, you're going to kill your project. It's going to keep declining and declining over time.
And how about the case, for example, when the increased supply is not met, like with increased demand? So how it can affect the token?
Yeah. Let's look at this graph. This was a research that was published quite recently. It's a bit complicated to understand the graph, but okay, so on the x-axis, it's basically the days. So 20 days before a massive token unlock, what happened to the price? And the price, the thing, there's the red, the green, and the blue is basically there's a small token release on that day versus red is a large token release. So if it's a small amount of token release versus percentage of trading volume, you do have a decline of price prior to the token unlock, but it recovers pretty quickly after. And then it's a pretty linear growth after that. Meanwhile, if it's red and if it's a large amount of token release versus what the trading volume, then you have a sharper decline prior to the token unlock. Then there's a pump slightly after, and then it suffers again after that. So they studied hundreds of different projects to come up with this quantitative analysis. So that's something to be really conscious about. What do you prefer? Do you prefer to be on the blue type of scenario or the red one? The red one, as you can see, the price went down, went up, but not as much as it was originally. And after 20 days, it's still below the original price before the token unlock. I don't think that's a good scenario. Meanwhile, blue is 20 days after, it's still below the previous pricing. So it still hurts you, but not as much. So personally, if you were to ask me, the entire market should stop having a fixed token release of some sort. It should be based on market condition. If the price is going up and there's a lot of market adoption, you can absorb more token release and vesting. Meanwhile, if the token is crashing, you should not have any vesting or more token being put in circulation. So that's, and I think a lot simpler in terms of programming on the code base. But the thing, if you don't have real users and you cannot predict what is your demand of real users, it's extremely risky to have that fixed release and new token being put in circulation. And the majority of the market follow that kind of pattern of release, which is why most projects end up losing and having a slow bleed over time and never really recover.
That's really kind of tricky to tackle a right moment, because you can be at the beginning and just waiting, and then you see that it goes down. You're like, okay, so that's the moment when the thing's going in the wrong direction.
Yeah.
But there might be a chance that it go up again.
Yeah, the thing, it could go up. But for example, here I'm showing you two examples. As you can see, was at some point a major pump. And that usually coincides with like the peak of the bull market. But after the bull market is finished, some of those projects never ever recover. Even if there's a new bull run, there might be another spike that come, but usually the all-time high keep producing every time, and it's basically a slow bleed. Those projects, they keep releasing new token in circulation, and they never really recover. And there's that constant slow bleed in terms of price. I think I would categorize those two projects as the loser to put into my loser type of bucket, something to really consider. Yeah. I think so. That's what I was explaining here, is that Web3 entrepreneurs should really consider having a token release that is scheduled, some and adopted based on market adoption. And that's a bit more similar to how stablecoin and Ethereum work. I think Ethereum has the creation of new token to be put in circulation, and they also have burning mechanism, so they can adapt. If there's a decrease in market adoption versus an increase in market adoption, they can play with the supply according to this. So to me, that's a lot better way of doing things.
And how actually they do like a forecast for this fixed release schedule? Is something it should be within the theory that it's based on, or it's based on a project?
That's thing. To be honest, I would claim that they're just putting and testing where the wind is blowing. They have honestly no clue. It's really hard to know upfront. Would you have expected Facebook to have billions of users? Back in the days when it was MySpace, the biggest social media platform, you would have never expected it could get so big. I really don't. Unless you base it on comparable project that have launched previously, it's really not easy to predict market adoption for something that is so new.
Yeah, I think it's like when you're going to go more deeply into vesting, I think we will cover most of the theoretical aspects.
Yeah, we'll have a further video on the vesting stuff because it's really, there's a lot of content to cover there. I think one other topic that I wanted to describe is that tokenomics, it's about engineering the supply and the demand curve to have an effect on price. But more and more projects nowadays have also a revenue stream that feed into that tokenomic model. So that could be done in a way that you have buyback of the token from the market. So you're basically using a revenue stream to engineer more demand for the token, or it could be released more like as yield to stake. So there's all kinds of things you can do with the revenue stream if you have it. And if you see Ethereum, it's the project that generates the most transaction fee of all of the project in existence at the moment. And even Bitcoin, the Bitcoin miners earn less by far compared to Ethereum miners. So that's interesting to see that revenue stream gives a real incentive for people to be part of that network. And in this case, Ethereum and Bitcoin, it's one thing, but Uniswap and GMX are both decentralized exchange, and they also generate quite a lot. There's a project that is not on that list, but it's a social media monetization platform called Fintech. They're generating more than Uniswap on some days. They've declined again as of late, but if you have a project that generates a lot of revenue, you can use that to really improve your tokenomic model quite a lot. So that's something that if any new project that consider launching a tokenomic model should really consider having a revenue stream that feed into this. And I think it's not just protocol fee. There's transaction fee. Like one example, let's say that it's a token where it's related to real world assets. Let's say that you buy real estate. When you buy the token, then their liquidity is used to buy back real estate. Eventually, you could rent the real estate, and the lending income is what feed back into your economic model. Or you can resell your real estate asset in order to bring back that money into your economy. There's also subscription, there's advertising, there's also market making that most Web3 funders overlook, but this could be a significant amount of revenue market making. So it's all kinds of stuff. And probably there's even things that I don't even have on my list there that could be nice to add as revenue stream to support the project economy.
So you would say for projects that are based on a token, so they would probably, it would be the best for them to use one of those like revenue streams.
All of them, I would say nowadays, they should really engineer some sort of revenue stream that feed into their tokenomic model. Because back in the days, it was not commonplace really, but it's something that is really important to make sure that you have that constant reason for the demand to be there. To be honest, it could be anything. It could be the sales of teddy bears. If you have a good brand like Bitcoin, you can sell merchandise, and the profit of that could be feeding back into your economic model. I've seen gaming projects that are like that. Any kind of profit that the studio makes feed back into the economy of the token. There's all kinds of possibility there.
And I think people would trust it more, that it's not only where you purchase the token and then it goes to speculation and then the price goes down and then it never goes up. But I think if they would manipulate with the revenue streams, it would change the behavior.
Yeah. Like just imagine the stock market. If you're talking about Apple, if Apple was not selling any products, they had no revenue, maybe people can still buy the stock for speculation. There are some stock like that on the stock market that are pre-revenue. If you, for example, there could be stock on the stock market that is about exploration for a new mining operation. Let's say you go speculate on them if they're gold or other precious metal in a mountain and you want to extract this. Sometimes those mining operations get to be listed on the stock market before they know what is the value and before they even have extracted the commodity and the precious metal itself. So what I'm saying is that most stock on the stock market is based on revenue stream, and then the traders use that as a proxy to evaluate if the price goes up or down, but it's a loose association. Elon Musk is able to drive a lot of adoption and demand of buying volume for the Tesla stock and his other companies just because it's him and he has really strong brand. But overall, there's still a relation. If SpaceX has a really bad quarter of revenue, it's very likely the stock price will go down. So that's why in terms of crypto project, this was not a thing in the past, but if you do have it, then it becomes a lot stronger for sustainability because that revenue doesn't disappear. If your token project goes bad, but you bought real estate, that real estate is still there to generate lending income and maybe selling back the real estate itself. So it's really something to consider. So another topic that people often use to reduce the supply is with staking. This is when the participant lock their token for a certain amount of time in order to get some sort of extra reward. And that's an example. So Bitcoin BSC, I'm not sure exactly what the project is, but it's not the real Bitcoin, it's some other project. And what they offer there is that if someone stake the Bitcoin BSC, they are getting an estimated 373% of yield per year. So now the question is, where is that money coming from? Because the thing, you can reduce the selling pressure when people are locked, especially if they lock their token for a year. But eventually, when it unlocks and people have obtained more than 3 times their token, then they have a lot more selling pressure at that point. So what were you able to do to generate all of that extra capital to make sure that once it unlocks, it doesn't crash the project? So this is something to be very much aware of, that you should never give that much return unless you can really generate it for real. And I think there's ways to generate it. But for example, yield farming. If you stake Bitcoin BSC, and then it's basically being matched with another token and put into a liquidity pool on an exchange, there's yield when people buy and sell that you accumulate return. So if this generates enough, you could afford to give a percentage to your users. But ideally, you would want to give less than what that yield farming activity is producing. Otherwise, there's nothing left for your project. And the thing, this is, to me, very high. Other thing is that if you do have revenue stream, like we discussed earlier, if the revenue stream is high enough, you can give a percentage to your stakers. That's another thing you can do. The protocol fee is the same thing. But you need to make sure that if the project is advertising a very high APY for staking, that it's not just taken out of the supply of the project, that they need to be generating the return somewhere. If they are not, they are basically just shooting themselves in the foot and kicking a can down the road. So this is the kind of thing that I look deeply when I look into project, is if they do something like that, but they don't describe where is this coming from, that means that it's very likely that they don't understand it themselves, or they're just trying to reduce the selling pressure upfront until the team can sell their own token. Because that's what you have to be aware of, is that if the team sell their own token before your period of staking ends, then they are basically stealing from you in a sense. It's legal, but yeah, it is what it is. So.
And how you would say would be an average percentage where you can okay, I can trust this project?
I've done yield farming in the past, and I can do between 100 and 200% during a bull run. And it's good in sideway market, as long as there's lots of trading volume. There's other consideration, but you can do quite a bit of return. Meanwhile, revenue stream, it depends. Like some company can extract a lot of revenue, but some other not so much. So protocol fee is the same thing. When I do market making, I'm able to do between 100 and 200% also. So I think I could actually offer something pretty good, but 373%, that one is maybe a bit excessive. It's not impossible. In this case, they say estimated yield, but some projects say that this is what you're getting, but they cannot make sure that it's true. Because the thing, if you produce 373%, but your token price has crashed 400%, you didn't actually get a return. So you have to make sure that the project is able to generate to me enough revenue of some sort to be able to afford that yield. So gambling casino, there's a lot of crypto casino now coming out like Rollbit. And I did evaluate, I believe that it's true that they can offer the yield that they're offering and all that stuff, because the casino itself generates massive amount of revenue. Yeah.
So you would say in that industry, you can trust that you can have a high return.
In some cases, and it depends on market condition. Bull run, things usually do really quite a lot better. Yeah, in the market right now where there's not a lot of trading volume, your yield farming will generate quite a bit less. And I think revenue stream, it depends. Is it coming from real estate? No, real estate, you get what, 10, 15% per year. So if you give 373%, that doesn't make sense unless you have very few stakers. That's the other thing, is that it's not your entire community. So if you're generating $2 million a year of revenue, but you have only 100 stakers, and you want to give 90% of those revenue to the stakers, possibly they could earn quite a lot. Right? And I think the more people become stakers, then that yield will significantly go down. So that's why in this case, they wrote estimated. So it's not impossible that this was true, but I think they threw the information, and I could not get a clear information where the revenue is being generated. So it's not good.
But it's really tricky of knowing. So you have to have a limit of people that should be there investing, but you also have to count how much money they have invested.
Yeah, but all of that is easy to calculate because everything is pretty transparent when it happens. So it's just basic mathematics. So it's not so bad. But
so they should tell in advance that you have a limit, not a limit, but you have a starting price from what you can invest.
Yeah, but the thing in this case, they wrote the word estimated. So to me, I'm fine with that, but I see some projects that don't say that sometimes, and they say APY 373%. And then to me, that's misleading because it might be a lot lower than that. And if they give 373%, but they are not generating it, then they basically just kick the can down the road. And then the laws of supply and demand on their price will get crushed eventually when those people unlock their stake. And then all of those tokens hit the market, and the potential selling pressure will be massive. So.
And what usually it happens, like the higher percentage will be when you do it during the bull run.
Yeah, because let's say that you were doing yield farming. During a bull run, there's a lot more transaction volume. But again, if you're doing a yield farming, that's a really advanced topic. But depending on how many people put money into that liquidity pool, your total value lock could be a lot higher than your trading volume, then your yield would be low. But if the trading volume versus your TVL is high, then your yield is really good. So that's why when I was getting 100 to 200%, is because it happened to be on project that not too many people knew about. And the trading volume was high compared to how many stakers there was into the liquidity pool. So if you try to do this on Bitcoin and USDT, it's not going to be as good because too many people know about this. But at the same time, you have impermanent loss and other things to worry about. But this is an advanced topic that we can go back into at a later stage. But all I'm saying is that staking is a good way potentially to manipulate your supply curve, basically.
But for the staking, it's just something like you invest and you just wait.
Yeah, and I think in some cases you have to lock for a certain amount of time. So you cannot trade the token while the locking period is active. In a sense, I said that staking affect the supply curve, but in reality, it's much more, it affects the demand curve. Because it takes those tokens out of circulation so that people cannot trade them. So it basically, it depends how you treat it. It reduces supply, but at the same time, it increases demand potentially. It can affect both sides of the equation.
But you would say that staking is for the demand side more.
It depends how you look at it, but it has an impact on the two curve at least. That one I'm clear to say. But because the token are locked, essentially they are not being actively traded, so they are not part of the supply. Instead, it's like but those tokens are still belong to the demand curve ish. Yeah, it's on the supply, I would say.
Interesting. And how you would say staking can be different from liquidity pools?
The thing, some project you stake and you lock your token, but nothing get done with the token. Other project, those tokens get taken out of the smart contract and are put into a liquidity pool to do yield farming. So, and this is basically you take that money and you put it on a decentralized exchange. And then when people sell and buy your token, then there's a transaction fee and you collect the transaction fee. And this is what we call yield farming. A lot of terminology, but there's all kinds of things you can do with the token when they're staked. And it depends on the smart contract. Sometimes they're there and the project cannot touch them. It depends which protocol they are using. So another very big topic that I like to discuss, and also this is something you almost never hear anybody talk about in the crypto space, but like network effect, it's like Netflix, Facebook, all of those companies, the more users they have, the bigger the benefit to the users. So if you have 10 friends on Facebook, the value is not as good as if you have 100 friends. And saying, if another competitor come to you and you have 1,000 friends on Facebook, and then you move to the competitor of Facebook, but you only have 5 friends, you go back to your 1,000 friends. So that's what a strong network effect is. It makes it very hard to switch to a competitor because you would have to transition your entire crowd with you to have and benefit on a new platform. So that's really hard to accomplish. Where it becomes interesting is that if you consider Facebook, the value is in your friends and your network because you want to interact with them. But when it comes to crypto, it's financial network effect. So the more people come after you, the more your financial return is large. And then you have an incentive for those people to leave the network after you. And that's the problem because there's a negative network effect that can kick in. As much as if you're early on, you want to be as early as possible because there's fear of missing out. And that's where you get the most return for your investment when you buy into a project really early because it has massive scalability. If 1,000 people buy after you, the price keep increasing every time someone buy after you. And meanwhile, when it reaches some sort of plateau, you have an incentive to sell your token and maybe come back later, but you don't want to be cut into a 90% decrease of price. So that's what I call a negative network effect. And that is really scary because imagine there was a negative network effect in Facebook. There was a reason for you to reach 1,000 friends and then quit, go somewhere else, and then maybe come back later. That doesn't happen on Facebook. So they can remain strong. But in crypto, you can actually lose massive users. So that's extremely hard to manage speculators versus real users. And that's why most cryptocurrency are being adopted by speculators that are just there to make money. They are not real users of whatever you develop. And then they are the first to be gone once you reach a certain size. And that's why you end up with a 90% crash of your economy. So this is something that I almost never see any project protect against because either they don't know to or they don't care because they are happy just monetizing short-term their crypto project and doing a rug pull or scamming their users. But me, it's my ultimate career goal is to fix those problems. And I think there's very few projects that have that built in.
So it happens with the people that created a specific token, or it can be really well-based project depending on the token. And then there are just people that start to speculate and then crush the token. Is it was at the side of people who create this token or the people that can speculate it?
But it's saying, so if you go back 12 years ago when Bitcoin launched, I don't think there was much speculation at that point. I think the people who are using it were really in love with the technology aspect of it and the utility. And eventually, speculators, people who just want to make money and they don't care about Bitcoin itself, went in and they realized that they could make quite a lot of money. And that's the entire meme coin type of industry came to be. And most projects nowadays, even though they don't want speculators, they are there no matter what, because people over the years have made just so much money speculating on crypto project because of that financial implication that is built in. The only crypto project that don't suffer that are stable coins, because a stable coin, by definition, the price doesn't go up. So there's no fear of missing out, and there's no way to really make money being early on. And our purpose for stablecoin is not for value creation, it's more for preserving wealth and having a refuge asset when the crypto economy goes to go down, basically. But the thing,
so is there like a different speculations that they can do, like, or manipulations, either tactics or it depending on the person that they do it like on their own ways?
Right now, I don't really know any project that protected themselves correctly against a negative network effect. I can go into a lot more detail about this because my current startup is about solving the problem. But a topic that will require an entire video to just to discuss that. But there are ways to protect against it, but it's quite advanced. And we'll come to it at some point. But right now, that's not the topic of today. But my point is that this is very much something that Web3 entrepreneurs that are thinking of creating a new token should be aware of. And if you're thinking of investing in project, you should really understand that potentially you only have a positive network effect into a token project, and eventually it reaches a plateau, and then it's potentially massive collapse. So you have to be aware that if the project didn't protect against that, it's very likely to happen. So if you want to preserve your wealth, be aware that those two things are present at every moment. Yes. All right. I think that's what I wanted to cover for today, but do you have a other question that we can discuss?
Yeah, I think I would go more interesting is something that I'm really curious and I have many questions. And I think topic by topic within economics, I think we will cover most of them.
Yeah, I think we can cover that in the next session. Meanwhile, I think the takeaway for today is that tokenomics is about engineering value and basically price action with mathematics and programming. But everything has to do with the demand curve and the supply curve and trying to engineer manipulating on both sides of that to try to achieve the desired results. And I think the same apply to everything you can conceive, whether it's real estate or a piece of paper, everything somewhat like basically has a price, and demand and supply has an impact on the price. So it's important to factor this in and consider that when you're looking at a tokenomic project like any crypto, because you have control over how the programming of the token is done, you can engineer new way of doing things. And that's why it's called programmable money, basically.
So you can manipulate people's behavior as well.
To a certain extent, but yeah, you have to know that there will be different type of actors in your economy. Speculators more likely will outnumber the real users, unless, I don't know, there's probably a way to engineer that you can reward true value to the real users versus speculators don't benefit. And to me, that's sometimes how I would think about staking. So if there's revenue stream and return to be made, I would give it to stakers more than the buying back the token itself. Buying back the token can happen just by real users and speculators buying the token. So I don't really have to touch it. But if I give a reward to my real users to stake and they are being rewarded for using the application the way I intended, then they should be getting a portion of the revenue. To me, that's how I usually think about it. And this way, I reward my real users more than the speculators. So the speculator can still have a bit of playground to play with, but unless they become real users, they're not going to benefit as much.
It seems like a really bad people are coming through all those things.
Bad, some of them. There's definitely scammers and all that. But in most cases, it's just, we live in a capitalistic world. Whether you live in a communist country like China, people are greedy everywhere in the world and they want to make money. More is better for everybody, for the most part. So that's human nature to want more and to have that drive to get it. So I would not call it's a bad behavior per se, but at the same time, you don't want the people who are just there for a financial return to take advantage of your real users that come, let's say, to play a game. You don't want them to crush the economy of the real players if it's a game, but even if it's any kind of application like social media application, your real users, you want them to be protected and not taken advantage by the people who come to make money. Yeah, try to make engineering model that put them in different buckets, ideally. All right, so this is our third session, and we thanks again Cyrator for hosting our video and deriving views and all that. But please subscribe, and we'll produce a lot more content and different type of content. But yeah, this series is about how we're going to preserve wealth and build wealth in the crypto industry over time. It's a big learning curve, but it's one that is worth it.
Exactly. Thank you a lot, Patrick, for your time.
All good. We'll see you next week.
Thank you.